Okay? End the day in consolidation, end the week off of the high, 25 to 50 pips to jam the traders, depending on the pair, and I'll talk about that in a minute. Okay? Good stuff. Another Friday example. They went up to the high. Friday, Sunday, Monday. Here's your formation. Here's our entry in our group. This might have been a scratch because you have a big entry bar. We might add a pass on that. I know Jim Nicholson got in right there, though. Okay. If this bar is too big, this is a pass. This is a no entry. Okay, now, here's the gap I talked about. This looks like buy the dips in an uptrend, right? So people got jammed up all in here. Friday, they closed, they stuck them because people thought the market would rally at the end of the day, right? Whatever the philosophy is. They gapped down, hit the stops that were all in this range right here. And all these guys that were stuck long in here, they gapped them right out, with this, hit their stops. Now, the shitty thing about the dealer that he can do about that is this. If the dealer closes at a price point on Friday and he gaps down 100 pips or 80 pips or 50 pips and opens, if your stop was 5 pips below the candle, he gives you the fill at 45 minus 45. How can he do that? I had an order in minus 5 or minus 7. The answer is that is the first price available on Sunday at the open. You were filled at the first price that was available at that level. So you thinking you have a nice stop in place and carrying stuff over the weekend is crap. If this has never happened to you, I applaud you. If you thought about carrying trades into the weekend, this is why you do not. You don't know what's going to happen with the economy the way it is. You don't know if they're going to raise the debt ceiling, lower the debt ceiling, fire the president. You don't know what's going to happen. You don't know if there's going to be some mass exodus in the Eurozone to get out from underneath the euro and there's burning and buildings collapsing over there. You don't know if there's going to be an earthquake. Market makers use that crap as the opening reason to gap the market aggressively against you. It's crap, but it doesn't give you back your lost equity when you hold a trade over Friday. I've seen gaps come all the way back to the low. I've seen sick stuff with the gaps. So what I'm telling you is, in not so many words, is don't carry trades from Friday. Take what's given to you and get out. Okay, now, here's a typical week. This is the structure that you need to memorize to understand the week. Here's what happens. You know I have the small pattern that I draw for you guys, right? The week is comprised of the same pattern. Why, you ask? The answer is because the behavior is the same on the larger time frames. So the market maker's counter to your behavior has to be the same. So what happens is this. Remember I drew this for you? I don't know if you can see that purple. Stop, hunt, high, drop, pull back, right? That's the intraday pattern as I've illustrated for you before. I'll do it again in a minute. Stop, hunt, high, drop. Now on the bigger picture, consolidation, stop, hunt, low, trap lower level shorts, trigger the stops of the weak long holders, run it up, a big fat M, which is a multi-session setup. By the way, the most powerful setup is the multi-session M and W. What is that? I'm going to show you pictures later, but here's one for you right now. The definition of a multi-session M or W is simple. Market makers hit a level, they repeat the level in another session or another day. This example here is Wednesday. Market makers made the high of the week, the HOW, the how, right? They came back near the HOW, but failed to break it because they had trapped volume or pendings at that area that if they come back and repeat the level, the traders are released. Okay? What the hell are you talking about? They released the traders. How many times have you been in a trade and said, if it gets back to break even, I'm getting out? If it gets back to -5, I'll take my lumps and get on with my life. How many times have you said, if it comes near where I got in, I'll just take what I can get and be happy I didn't blow my account? If you said those things to yourself, you're not alone. This typical M&W behavior is based on that mentality or psychology. The traders that think like that because they don't understand the market put their pending orders in around here to get out at break even. They'll put their take profit at +1, 0, -2 just to get their money back and be out. When market makers come near the level, they don't allow that volume to be released back into your accounts. They don't want to release it back into the wild. Think for a minute. If there's $500 million at Wednesday's high or the high of the week, they're not going to break the level. They're going to come near it because, remember I told you they're so greedy, they got to grab whatever money's still there, and then they'll shift away for 3 days. The market is based on a 3-day, 3-level cycle. Write this down. The market is based on a 3-day, 3-level cycle. Market makers will trap lower level shorts, higher level longs, and make a unidirectional swing for 3 days or 3 levels. If you look at this example that's up there, you have a false move week beginning, which is a variation on the pattern, stop hunt high, coming out of Friday, which if you notice, this is exactly what happened this week. They hit it again Asia, hit it again London Open, bottom fell out. Okay? Now, they then repeated this behavior on a 2-day cycle, stop hunt low, jam the traders, run. This run was made 3 levels or 2 to 3 days, approximately. The midweek reversal, which there's a midweek reversal almost every single week. You can have multiple levels in one day. Yes, that would make it a 2-day cycle. Now, Wednesday, they put in the midweek reversal like clockwork right here. They trap for the high of the week. They repeat the level but fail to break it. The spread opens up to pick up any pending orders on the other side of Wednesday's high or the high of the week. If you notice something, the highs of the week will coordinate with the stop hunt triggers at the beginning of the sessions. Think. This is a stop hunt high trap for London. They repeat the same stop hunt in the U.S. session. 2 sessions formed out in the middle of the week at Wednesday after 2.5 days of rise at 3 levels looks like a midweek reversal to me. You then get a unidirectional swing. Unidirectional meaning one direction. A unidirectional swing for 3 days. My friend David Gian and Bruce from New York would have caught this as a swing trade and maximized their gains looking to exit this trade Friday U.S. session. Why? Friday's the last session of the day. We know the low would probably come in between 9 and 10 or 9 and 11 in the morning. At the session changeover, the reversal comes. So we look for the low of the day, London, to look for our exit. We get the spike, a repeat of the level, and into consolidation to end the week. If you are a swing trader, that is your exit. Level 1, level 2, level 3. 3 levels of drop, spike the low, end in consolidation, lights out, a couple hundred pips in your pocket. The pattern that I'm going to draw for you and illustrate for you is observed intraday, intra-session, and intra-week. It also plays out on the dailies and the 4-hour chart. But for our purposes here, we're looking for intraday swings and spot trades only. This information will help you in your larger term charts and any other market. That stuff can be traded. Okay. Here's a typical weekly market structure, as I've just discussed it with you, but illustrated again on a different chart. False move week beginning. Spike the low, spike the high, into consolidation. Accumulate and evaluate. Market makers accumulate and evaluate. I hit the high, hit the low, picked up some pennies. What do I got? I spiked high again. What do I got? I spiked low. What do I got? Accumulate and evaluate. Steve, what are they evaluating? How good of a trader I am? No. They're evaluating the contracts and the money. How it's straddled over their spread. That's all it's about. The business is about the money. Now, you have a false move, spike the low. The V3 is vector 3 candles. I'll talk about that in a minute. There's the big fat W formation. Spike the low, pull back, hit it again, jam up the traders, validate the short sellers. Averages are open. This is a down cycle in any other textbook except mine. Straight rise into consolidation. Stop hunt low, rise. Next night, stop hunt low, rise. Next night, grab some pendings. Stop hunt low, rise. Rise big. 33 trade. Another trade we're going to talk about. A 33 trade is a setup. I'll lay the rules out for you. On day 3 of the 3rd level, you have an intraday 3-level rise. That trade will absolutely lead to a reversal. Think about from the market maker perspective for a minute. Every time a retail trader buys, a market maker must in fact sell to him to provide the liquidity. They are not pairing you up, Lou, in New York, with Abo in New Jersey. They're not doing that. They are managing their risk by offsetting that by taking some buys and some sells to manage their risk. But they are not going, oh, let's see, Lou wants to go long. Let me find Pete in Southern California. Looks like he's a seller. Let's match those two guys up and let them hold hands and go against each other. That's not what's going on here. That is a marketing ploy, and it is pure bullshit. Excuse my French. The dealer, the reason you get filled so quickly, the dealer takes the other side of the trade. He has some shorts and some buys. That's just the way it is. The short sellers offset his open long equity. The long holders offset his short equity. It balances. Thanks, Russ. Forgot what language it was. Okay, so now, keep in mind, the 3-day cycle. day 1, day 2, day 3. You have 3 levels of intraday rise after the stop hunt. The reversal is imminent. I just was talking about market maker's equity. He's not unlimited. Here's what he does. You're a retail trader.